Hi traders, a lot of people have been asking me about an example of executing a forex trade, how to set stop losses, how to put in take profits if you want to, and how to execute the trade off your MT4 platform. So I've just set up a demo account to show you this. Apologize for the sound. I'm doing this off a desktop. So if it's low, please just try and put your volume up as high as you possibly can. Okay. Now, components to the Forex trade itself. So initially, yes, there's going to be analysis. You've got to be able to figure out where you believe that the market is going to go in the next, for however long, or how many pips you'd like to collect. Now, one of the things that I'm an advocate of when it comes to Forex trading is knowing how many pips that you want to be able to collect. It's not about, I'm going to jump into a trade here and I'll just keep going until the market's down here somewhere. That's a mistake a lot of forex traders make. Trust me on this, because majority of the time they are able to pick direction. It's just that they hold on for too long, or they don't hold on long enough. So how I trade is, again, being a lifestyle trader, is I'm in the business of just collecting a set number of pips. If I know that there's going to be a bit of a false move happening, and I believe the false moves are going to be 20 to 30 pips, well, I'd be happy to jump in and out and do maybe 15 or 20 pips max. So say for instance on this candle here, from the top to the bottom, which is a 15-minute candle, that's 20 pips. Now, if I was just in the business of saying, I'd be comfortable, once you've got a decent sized account that is, I'd be comfortable doing maybe a standard lot um, on any currency pair that meets my requirements, and I'm running for maybe 20 pips. Well, on that standard lot, a 20 pip movement will still get me $200, pounds, euros, whatever currency that I'm using at that point in time. So if you're happy with that, you're happy with that. Now, once you're growing your account and you're at a stage where you can put more lots on that trade, so a 5 lot trade in 15 minutes with a 20 pip movement may yield me £1,000 return. If I do 10 lots on that, that would be a £2,000 return. So if you can nail your strategy and you can grow your account, gradually you can grow to a point where you can do multiple lots and make a very good amount of money doing exactly the same thing. Okay, so let's say for instance we've done our own whole analysis. Now, in most instances, say for instance, let's take the United States for example. Um, they've got a requirement now that most of their forex accounts or any offering to a U.S. citizen should only be at a leverage of about 50, I'd say. So what that means is that you can, whatever your actual deposit is in your, or what your equity is in your forex account, you can only multiply, or you can only trade currencies to the value of 50 times what the value is. So, for example, if we have $1,000 sitting here, you can only trade $50,000 worth. If we have 5,000 here, then we can only trade $250,000 worth of currency. Okay, that's just utilizing leverage. Now, when it comes to um, your lot sizes, well, what it effectively means is that if you're utilizing a mini lot, or if it's say 0.1, what that means is that you possibly have an account that has about 10,000 or more in there, in terms of the leveraged combined with your equity. And what that would mean is that every time you do a 0.1 lot trade, you're effectively trading $10,000 worth of currency. So if you're trading Euro USD currency pair, you're trading 10,000 euros worth of currency on that particular trade at zero point 0.1. If you're doing a one lot trade, then you're using 100,000 worth of that currency. So if I had 5,000 in my account, and my account was leveraged at 50 to 1, then I could trade up to 250,000 level or amount of currency, which would mean that I could at least trade up to about 2 lots in any trade. Okay, so leverage counts there. Now, margin is something else. Now, how brokers would calculate margin is to say, if your leverage is allowed at 50 to 1, then that's um, 1 divided by 50, and that would give you 2%. All right, so that just generally means that whatever your actual equity is in your account, which is 5,000 for us here, right? Um, the broker will set aside 2% of your account to ensure that you're able to meet any losses that are incurred. Now, let me correct myself there. This is not necessarily 2% of the your equity balance. It is, say for instance, I do a 100,000 units of the euro, and let's just for argument's sake say the euro currently is selling at $1. Okay, oh, so what we'd be doing is multiplying 100,000 by $1, which would give us 100,000, and then we'd multiply that by 2%. And that is what would give you what the margin requirement is to be able to take the trade that you're taking. So at this stage, you'll say, based on our equation, it would say $2,000 is required for us to be able to meet our margin. So down here, and I will show you in a little while once we've executed a trade, where we'll say balance of whatever the equity would be, um, whatever your profits or losses are here. So it'd be added or minus, and then your free margin. Well, if our trade requires a margin of 2,000 in this case, this will say free margin of about $3,000. Now, you've possibly also heard of margin calls, where traders haven't been able to meet margin calls. So if you take multiple trades, for example, and we've just taken a trade for that required a margin of 2,000, another trade that required a margin of 2,000, we only have $1,000 that's left here. Okay, so what the broker will do, they'll say, okay, we've got a requirement now where you need to have 40% of, say, whatever your trade volumes are, um, sitting here as free margin. If it goes below that amount, we're going to issue you with a margin call, and they'll give you a certain amount of time to be able to um, uh, add. So they'll say, okay, you need to add this much money to get it back up to the 40% mark, and if you don't, well, what generally happens is they'll close you out on your trade. Okay, and that's one way of wiping out a large chunk of your account. So generally speaking, we try not to trade too much of our balance. Certainly, you can do high amount trades, utilize higher margins if you're guaranteed literally that you've got to know what you're doing in order to ensure that the market's going to move in a particular direction continuously. So without trying to confuse you guys too much, I apologize. I am trying to keep it as simple as I possibly can. So let's do this. Let's jump into a trade. Please no one judge me on the quality of this trade right now. This is only about 10 a.m. AUD. So here we go, AUD USD. This looks like it's going down a little bit. This is not how I want you to trade. Put a lot more analysis onto your trades. This is just an example, okay? So we'd go back into the Market Watch section here. Now, I haven't shown you how to set this up, so let's get out of this. Now, off your MT4 platform, this is how you would trade. To launch MarketWatch, the pane on the left here, what you do is either click on this arrow button here, up and down, and that would get you the MarketWatch pane on the left. Or, if I get out of it, you just simply go into View, scroll down, and then click on MarketWatch here. Okay, so the currencies show up. The other requirement, well, it's not a requirement, but you'd like to have is the terminal down the bottom that shows you your information in regards to how much money you've got in there, what else is going on in relation to your trade. So you can go back into View, scroll down, and click on Terminal there, or if you just click this button here, okay, and your terminal will come up. Now, so what this is showing us, and some of you might have seen mail being sent. It sounds like with your MT4, there's mail coming into your accounts. It's this down here. Okay, so all of this. Now, I've set up just a demo account with Vantage to show you what's going on here in the morning. Okay, so let's say, for instance, that this market is heading down. What we're going to do, once again, we've done our analysis. What we do, we go up to the left pane here, and we'll click on this whole AUD USD bit. Okay, double click on that. Now, this is where we execute our order from. So make sure you've got the right currency pair up the top here. On this drop-down menu, you can scroll up and down to select it. But if you've clicked on one of these properly, then your currency pair should automatically be selected. Here, where it says volume, this is what I was talking about earlier in relation to your the number of lots that you're trading. So just make sure. See, this is 0.02 is a micro lot. If this was 0.2 instead of 0.2, that would have been a mini lot. And this here, where it says 1, is a actual full standard lot. This micro lot, you're literally only trading about 1,000. A mini lot, you're trading about 10,000, and with a full lot, you're trading 100,000 of whatever the base currency is, right? The other thing to note is with micro lots, so if this was here, this is a 0.01, that's a micro lot. Every pip movement that you have in the right direction is 10 cents profit. Every pip in the wrong direction is negative 10 cents. With a mini lot, which doesn't show here, if it was 0.1, then that would be $1. And with a standard lot, that would be $10 profit or loss that you'd be making, okay? So we select whatever volume we want. So I'm going to be cocky here. I'm going to put down a full lot, and that's going to show you margin as well. I'm going to always leave this at market execution. Pending order can be utilized if you actually wanted to select, you know, you have your pendings, you believe the market's going to come up here and hit it before it goes back down. So you can actually set your pending somewhere up here. Anyway, so we'll say type market execution. And here's the other thing also. If you're going to short the market, meaning to say in binary options terms, you're putting, you'd click on sell by market. See, so it's already going down, so we're missing the trade a bit. You'll click sell by market. And if you want to do a long trade, meaning to say that you believe the market's going to go up, it's buy by market. Okay. Now this difference here, okay, this is the amount on the sale. So if we sell, it's up here, and if we buy, this is the price we're going to get executed at. Okay, look at the difference between the two. Notice this is 3122. This is 3103. Okay, that is like a one. It keeps changing. It's probably about a 1 point something pip difference. That is the spread. Okay, so sometimes when you're executing a trade and the spread is too large, you'd probably say, you know, you don't want to take that trade. Now, I want to show you this. I'm going to click on sell by market. Notice how the spread is expanding. I want to show you, you're going to see a green line, a dotted line that shows up on the screen. Okay, I'm going to click on sell by market. Keep your eye on the screen, and you'll get to see that green line. See where it's entered us at? Okay. Sometimes you'll notice where if you enter a trade, your green line is up here somewhere and the candle's down here, you'll be like, what the hell just happened? That's where your brokers applied a spread. Okay. We've gone into the trade. We are already negative 14 in the money. Sorry. Poor choice of words. Not in the money, you're out of the money. So although the candle is slightly lower than where we've entered into, we're still negative 15 at this stage. And the reason for that is, again, the spread. Okay, so here's what we do. It's not advisable for us to take a trade and leave stop loss here, because at any point in time, anything can happen. You could have a nuclear blast or an earthquake or whatever, or a prime minister of a country says something, and next thing you know, this market just goes boom. Okay, so what we do again is highlight that. You right click on it, and then you do click or modify or delete order. Now, the page that we initially used to execute the order is now back up again. Now, a lot of people will say to you that, hey, you know what, Shiva, you should have put in your stop loss here when you executed the order. Look, yes, that's true. You probably should, but realistically speaking, depending on what sort of trader you are, if you're day trading, or if you've just seen an opportunity, you know the market's going in a specific direction, and you need to jump into that trade. You jump into it, and then you quickly come in and set your stop loss. That's how it's realistic. Okay, I'm not going to tell you ever that you need to do something a certain way because you're going to be more of a realistic trader. Now, here on the charts, this is what they've put my entry in. That's where we're at. This is now beautifully moving down. Now, okay, let's just put the stop loss in first before I talk any further. So generally what I do here is to say, okay, copy. Okay, what you can do is figure out where your high of the day is or low of the day is. I generally will put my trade. So if I'm doing a put, I put at a much higher amount than the actual high of the day. It's just to be safe, right? That's the initial. What I do here is I just do copy, and then I'll click on the modify. See that? That's put my high. This is the difference between the spread. So this is where I got in at. Now what I would do is I'd grab that and then I'd just move it to a point where I believe, which is this is the official high, and then I'd probably move it to a higher point somewhere here. Okay, let's accept the terms. That normally doesn't come up. Okay, and that now has moved my, okay, we'll just do, okay, that has moved my stop loss to this point. Now, surely, if you're in a position like this where the market has moved very comfortably in your direction, then what you can do is bring your stop loss down. And this is the fastest way of doing it that I find, where you can just grab it and move it down. Okay, we can put it here as well, right on top of where our entry was, or you can actually move it lower to this point here to ensure that if the market does come and hit, you don't actually have a loss. Now, I wouldn't do that with most of my trades. I wouldn't move it around and get to this point because at any point in time, if I've done my analysis and I believe that the market's going to go down, okay, I will ensure that my stop loss is high enough for maybe where the market comes back and issues another stop hunt where I don't get stopped out. That's another reason why a lot of traders will lose trades, okay? So be mindful of that. Now, with take profit here as well, again, you can do the right click and you can put in a take profit amount. I generally don't because I'm not sitting here expecting a an amount, nor do I leave my trade and I walk away. Sometimes I'll go make a cup of coffee or something. But generally speaking, if I'm expecting my trade to go in a specific direction, I really want to be in and out in the shortest possible time. So here's what I would do. I'd say, okay, from there to here, right now, it's five pips. If I wanted to be in the market for about 10 or 15 pips, then I'd leave it be and I'd say, okay, when the market is done about 10 or 15 pips, then that's when I will get out of my trade. Right now, here's the difference. That's my entry price, and that is the present price. Okay, so my entry was 31.05. This is at 3058. We're at least about 5 pips in the money. So on a one lot trade, AUD USD, here's what the broker has done. So here's what my balance was. Here's the equity now, including what my profit has been so far. Okay, this is the margin. That was the calculation. So what the broker has done, they've set aside this amount to cover any possible losses that I may have. Okay, notice how there's changes in the free margin amount here in both the dollar value and the percentage amount. So what this basically says is that there's 691% of what the margin requirements would be anywhere, or the percentage requirement. So if this drops to say 40% or so, something along those lines, then chances are I might get a margin call. So some brokers will be lower, some brokers would be higher. And so that's the sort of research that you need to do before you jump in with a broker. Here as well, see how the dollar value keeps changing. So once this goes up, my actual free margin would go up as well. Okay. Now, when you then want to exit out of a trade, and you say, for instance, my 10 or 15 pips or whatever it is that it is done, you want to exit out of a trade, what I do again, highlight this. So say, for instance, it's like this, highlighted just by clicking it anywhere on this whole entire line. Right click, and then you'll simply just do close trade. Okay, that order's been exited, and now I've got 5,055 in this trade. So however long we were in that trade for, I've just made 55 bucks. Okay, and that's the simplicity of Forex. Alrighty, so let's hope that's answered your questions. If there is anything else, then please just comment in the section below and I'll try and answer that for you.